Hi, guys. Welcome to the How I Raised It podcast, the show where you get an inside, unfiltered look at how real entrepreneurs raise capital for their businesses. I'm your host, Nathan Becker, and today's episode is with Jennifer Smith of Scribe. Scribe is software that captures your processes and turns them into a visual guide, like for onboarding new customers or new hires. Jennifer raised $30 million while pregnant, so we discuss how she did that, including her super tight 2-week process and the sequencing that she used with investors. If you're tuning into this podcast, learn how to raise capital for your business, I've created a super valuable free welcome package for you. It includes a list of 2,500 investors who don't require a warm intro, plus 200 questions that investors are going to ask you. So it's really going to help you get ready to raise money. To get access to this, click the link in the first comment. While you're there, please leave us a nice comment, hit the like button. We really appreciate that. Last but not least, if you enjoy this conversation and think someone else would too, please share it with them and hit that subscribe button to get all our latest episodes. Thank you. Now sit back and enjoy this chat with Jennifer.
Welcome to How I Raised It, the podcast that goes behind the scenes with entrepreneurs who've raised capital. We uncover the tips, tricks, and techniques they use to get investors to write a check. Strap in and turn it up.
Hi, welcome to another episode of How I Raised It, produced by foundersuite.com. Today I have Jennifer Smith of Scribe coming to us from San Francisco. How's your day going?
It's good. I'm excited to be here.
Awesome. Well, let's jump right into it. What is Scribe?
We're a software company based in San Francisco. We make software that makes it really easy to capture and share how to do something. So you can think of it as really easy, quick, automatic process documentation. You hit the record button, you do a normal process, say you generate your quarterly sales report, you hit stop record, and boom, Scribe will auto-generate step-by-step written instructions with screenshots that show how to generate a quarterly sales report. And that's something that you can use whether you're onboarding new team members, whether you're scaling up your team and trying to implement best practices, or whether you're trying to explain to clients or customers how to use your software or how to troubleshoot a problem that they're having.
So that sounds cool. We've been using like the budget way of recording a Zoomcast to show a product demo or something. But it sounds like it goes way beyond that. So if I recorded a product demo, let's say it's a 2-minute product demo, what is it inserting in there that's sort of different than just a straight up recording?
Yeah. So it's auto-generating a step-by-step written guide, like an SOP or a job aid or process documentation. Goes by many different names to different people. But it would literally say like step 1, navigate to www.foundersuite.com. Step 2, click on the get started button. Click 3, right? And it would have screenshots and it'd be auto-generating the text showing how to do that process. So it's good for places where you have to show someone how to do something, but you don't want to take the time to record a full video for it. I mean, if you think about it, anyone can generate a recording. Your computer comes automatically with video recording software. What percentage of your company's processes are actually documented in a video recording or written down in some kind of step-by-step guide? Most companies, it's less than 1%, right? It's a fraction of a percent. And that's because it's a lot of work to do that. And so we said, like, how do we make this really, really easy and simple for anyone to capture and share how to do something? And so we said, literally, like 2 clicks of the mouse, you hit record, you do what you normally would have been doing anyways, you click stop record, and now you've got a customizable, editable document that can live over time.
Cool. So the output is a document with screenshots, or it is something that is it like a text transcription that accompanies the video, or both?
There's no video. It's a step-by-step written guide with screenshots. So it'll literally say step 1, go to the website. Step 2, click here. Step 3, type this. Step 4, click here. And it'll auto write the text and insert based on what you're doing. And it'll have little screenshots showing exactly where you were on the page and what it was that you were doing. It's all the info that someone would need to be able to follow along and do that process themselves.
Very cool. And where did this idea come from? How did you come up with this?
You know, there's a famous Steve Jobs quote that it all makes sense. You can connect the dots only when you look backwards. And like that's very much how I feel about, Scribe and where we are today. I was a consultant for many years at McKinsey, and I did a lot of organization and operations work. So literally going into operation centers and looking over the shoulders of agents for 8 hours a day. And when you do that work, what you realize is there's all this process knowledge that's just hidden in people's heads. As a consultant, my job was to figure out who the best people were and then what they were doing that was different than everyone else. And they would always tell me like, oh, here's all the stuff I was trained to do. And I'm going to date myself because this was like 15 years ago. They'd pull out a really thick binder and they'd thunk it down on the desk and be like, I took 2 weeks and I had to memorize all of these processes and procedures for my company. But actually, that's not the way we do the work. That's just like what's written down, like I actually do it this way instead. And you look over their shoulder and they've got 15 different screens and they are alt tabbing, just like trying to work across everything. And, we would take that information as consultants and write that down. And I always thought like, well, if those people had just had a way to capture and share what they knew how to do, like they could have scaled that really easily across their colleagues. Right. And then, fast forward and I'm working in venture capital and I spent a lot of my time talking to buyers of enterprise software. And I would just ask them like, what are your biggest problems? What are the challenges you're trying to solve? And I kept hearing this theme of, my company runs on processes. This is the work. This is literally what are we doing every single day? And all of this really important knowledge mostly just lives in the heads of my people. And it walks out the door every day at 5 p.m., at least proverbially. And I got to hope that it comes back and there's never really any way for me to capture it. And so with Scribe, we said, well, couldn't we use technology to do that? I mean, things have changed so much now. Like what if we could watch experts, people who know how to do something special and interesting, people who know how to use a particular software or an expert in that software? What if we could just watch them do the work they normally would be doing anyways and capture all of this special knowledge that they have? What if that just became automatic, like digital exhaust, just a byproduct of them doing their jobs? What could you now do as a company if you could scale that information? It's almost like taking what's in your head and now turning it into something that's scalable, whether that's like media or software, right? I mean, one of the big values of this podcast, for example, is that multiple people can listen to it, right? It can benefit many, many people. If you think about tribal knowledge within a company right now, that's mostly just shared one-to-one. It's someone asks you a question, they pop their head over the cubicle, et cetera. And so we said, well, what if we could make that more like software or media? What if we could make that infinitely scalable and do it in a way that takes no additional time from that expert?
Cool. Yeah. No, I can totally see the use case. I'm already thinking of how we could use this here at Founder Suite. There are just certain processes and tasks, like even integrating your email with Founder Suite. You've got to go whitelist on Google, and it's just a couple steps. It's not rocket science, but it's a pain in the ass. And we're
probably get a bunch of questions. People don't do it exactly right.
Yep. So I totally get it. Cool. Very cool. And you guys have been around. You've been launched for a year. Is that right?
We've been around for a bit over 3 years.
Excellent. Did you like working at McKinsey? What was it like being a management consultant? I think there's this perception, very glamorous, very hard work. What was it like? Give us a little tangent here, but.
Yeah, I joined the firm when I was 20. So I had never really known anything else. And I knew very little about what consulting even was. So, when I went to college, came from like a small town in upstate New York, showed up, and there are basically two kinds of people who recruit on campus at the time, at least. It was the investment bankers and the consulting firms. And I did a summer at Lehman Brothers. Now I'm really dating myself. And I looked around and said, all these people seem to care about is making money, and they don't seem very curious or thoughtful about the world. This doesn't really feel like my tribe of people. And then the management consultants came on campus, and I was like, oh, these people actually seem like pretty thoughtful. And they're pretty curious about, what makes businesses tick. Like, how can you make organizations better? How do markets work? So these kind of feel like my people. I'm going to go there. And I loved it and hated it and never felt somewhere in between. Mostly loved it. Definitely had some nights where it was a Wednesday at midnight and I was stranded in Tulsa and couldn't get home, kind of situation. I spent, I think it was 250 nights a year on the road. Which, when you're in your 20s is a ton of fun. I think I would have a hard time doing that now. Thankfully, my travel schedule looks nothing like that. But I feel very fortunate because it was a really great, I think, early learning experience for, not just like, what does it mean to be a professional and show up to work and write professional emails and be client facing and all of that, but like a pretty rigorous way for how to approach problem solving that I carry with myself today. And I probably have a lot of inherent biases from having been a consultant, some bad. I think many quite good. I find when I like work with another consultant, even if I don't know that they were a former consultant, like we work together better. It's just a little bit easier. We kind of have like a shared, and then often we'll find out later, I'll be like, oh, you were a consultant too. Okay. Well, that might explain why we kind of have like a similar approach to brainstorming or problem solving.
That's funny. Yeah. Well, I won't go too far down this rabbit hole, but I was curious, like if you think having a consulting background has helped you be a founder, or if possibly it even is a bit of a hindrance because consultants are great at advising and consulting, and as founder, you got to do right. Like,
Yeah, I would say the Venn diagram is pretty non-overlapping. If in that, if you think about sort of the skill sets and the kind of people who are attracted to consulting versus founding, like obviously there are former consultants who are great founders, and vice versa. It happens. Yeah, I've really enjoyed both experiences. But yes, it is quite different. It's really almost like opposite ends of the spectrum. You go from, advising and you come in on a project for 3 months and you leave, all the way to like extreme ownership. This is your baby and you live this and breathe this every single day, including like in the depths of the night in your dreams, right? Although I will say that there's a former McKinsey consultant who runs a venture firm now. And I think he disproportionately invests in former consultants, and he disagreed with me. He actually had data. So I'm doing this entirely based off of a gut feeling of saying, like, I don't know that former consultants like would naturally lead to be better founders than sort of like your average, kind of like, great person. But he said statistically, I think he had done some sort of data analysis around it. And he was like, actually, like they make better founders on average. Like they have better outcomes than your average founder. So who knows? Data should trump my gut feeling.
Your gut feeling. That's funny. I think I have a little bias against consultants, only with the stereotype that, hey, you're great at thinking, but not getting stuff done or getting GSD, right?
Yeah. It's a very different skill set.
But I guess there's also probably the correlation there. I mean, if you get into consulting, you're a very smart person. So that's going to help you as a founder or whatever job you take, right? It's like there's that high bar to get into consulting.
There's maybe a question of whether you go native or not, right? Like, does consult? There's a lot of people, most people who are in consulting only stay for a few years. It's such a strong pyramid, right? So maybe there's a question of like, how much did you really embody the consulting way of working versus you are sort of a transitory visitor on your path to what it is you really wanted to do.
Interesting. Well, since we're sort of talking about career already, and we'll get to the fundraising in just a minute, but you then spent a couple of years at Greylock, a pretty large venture fund. Maybe just talk about your role there and what you learned from that you're now taking into the startup world.
Yeah, I got really interested. So I joined consulting. It was McKinsey in DC. Like had never met anyone who worked in tech or had been a founder. And then I went to business school and I met some people who were from the Bay Area and who had built companies or been investing in companies. And there was something about them that just felt like my tribe even more. And I said, like, these feel like my kind of people. Like there's something, they've got like a glint in their eye when they talk about what they're doing. Like this is where I want to be. And so I transferred to McKinsey San Francisco, having never been here, just sort of on a hunch and a whim. And then I met a bunch of people here who were building and investing in companies. I said, this is what I want to do. And so being at a place like Greylock to me was like being in Candyland, because it meant that really interesting people came through our doors every single day. And I got to meet all kinds of interesting founders who were really passionate about what they were building. Like even if you don't share their passion, right? Even if I don't really care about distributed storage or whatever it might be, like the fact that they care so deeply, right? And they can talk to you about it for hours, their passion becomes really infectious. And to me, it was just really exciting to be able to meet with like some of the people who are best in the world at what they do and pick their brain about the thing they think every day about, and learn so much and get to be, a tiny part of their journey of building something that, everyone's trying to make really special. So to me, it was just like an incredible crash course. And also just a really, I think, kind of energizing experience of meeting people who I admired and liked and respected and enjoyed spending time with and learned a lot from.
And what was your role there? LinkedIn says head of biz dev and partnerships. What is a venture fund?
What does that mean?
Yeah.
Yeah. It means a bunch of different things. It was basically like helping our companies. It was twofold: helping our companies like build out, go to market, and then building our network, and relationships with, customers. So buyers of enterprise software. So the thing we were trying to answer as a venture firm is like, what are customers buying? What will they buy in the future? What kinds of problems are they trying to solve? What are they paying attention to? What trends are they seeing? What are they putting money behind already? Like, what are cool companies that might be on their radar? It helped us be smarter about where we wanted to place our bets and where the puck might be going. And then for our portfolio companies, it's helping them think about, like, who should your early customers be? Okay, now that you're starting to scale your customers, like, who should you be talking to? Can we help make connections in those areas? How are buyers on the other side making evaluation decisions? Like, how should you be thinking about structuring, your team and your product early on in light of that?
All right, last question on this, and then we'll get into raising capital for Scribe. But what is maybe a misperception about getting into VC? I think a lot of founders have this dream of, after their startup is a success, they're going to become a VC, or even people just out of business school have this dream of becoming a VC. What's maybe the less spoken up truths about being a VC? Like, why maybe it's harder than it looks, or you tell me.
Yeah. I don't really understand why people glamorize it and fetishize it the way that they do.
Right.
It's kind of baffling to me. I think we do this with a few roles. I think we do this with venture capital. I think we do this with product roles also, in the Valley. There's a few of these, and, like, they're all great. They're all great roles. I don't really understand why there's as much, like, excitement around it. I suspect it's because there aren't very many of them. And so you just kind of have, like, fewer numbers, and that drives, an interest when something is so selective. It is quite well compensated. But the work is very different. If you are a founder and you love building your business, right? You love being in the trenches every day, rolling up your sleeves, like working with a team, building a company. You do none of those things as an investor, especially early stage. Like, if you are an early stage VC, you are a lone wolf. You are a deal guy. You are a hunter. That's what you have to get off on every day. You have to love the thrill of the chase, like waking up every morning and thinking about, like, what is the next hottest deal? How am I going to find it? How am I going to win it before someone else? And that's what really motivates these people. And the ones who are great at it, like, it's quite exceptional. But that's not a skill set that you see anywhere else. So, like, also the Venn diagram of, like, what makes a really great investor who's very happy with what they're doing, it's, like, I would argue pretty non-overlapping with kind of any other role that you might have. And I think I talked to a lot of founders and folks who have been part of building companies, and they say, oh, I'm very excited to go into venture later. And I say, well, what part of it excites you? And they're like, well, I really love helping founders. I really want to be advising. I have a lot of go-to-market experience or product experience, and I really want to bring that to bear on companies. I'm like, great, that's not an investor. That's, go be an advisor, right? That's great. Or go build a consulting firm or whatever it is. Like, investors spend time with portfolio companies, but they should be spending most of their time hunting for new deals.
Yeah, no, I think that's super, super great advice, or great, insights into that. Like, I think there is that perception as VC, you're just sitting back on your throne, knighting the different startups that come past that you like, but it's really like you've got to get scrappy, and because there's a lot of VCs with a lot of money chasing the same very few hot deals, and that's a hard job.
Especially, in like a really hot funding environment like the last few years, it can look a lot like sales, frankly. Like, it's kind of glorified sales. It's really well compensated glorified sales. And sales is a very hard job, by the way, right? So it's like, it's not to say that it's easy, but you have to convince people to take your money over someone else's money, and money is becoming increasingly commoditized. And there are a lot of reasons that, people will differentiate themselves in ways that they can do that and be quite successful in it. But at the end of the day, it's just about convincing people to take your money.
Yeah, really good. So let's talk about raising money. How much have you guys raised for Scribe, and over how many rounds?
$30 million over a very small pre-seed, a seed, and a Series A.
Great. Let's go chronologically. Maybe talk about putting into that pre-seed. Did you guys have anything built yet? Was this just an idea you had based on your time at McKinsey, or what?
Yeah, we had practically nothing built. We built some very, very basic kind of early, I don't even want to call it an MVP. So it was mostly like based on, me and a dream. I can't even remember. I don't think we had a PowerPoint deck even to give you a sense. And, when you're doing really early stage first check investing, like it's mostly investing based on a team anyways. And so we raised a very small amount. I wanted to raise the least amount that we needed to be able to build a basic MVP, build a really early team, and do some customer validation. And so like, look, I believe that people care about this thing, but we need to actually go test and see, like, do they actually care? What does this look like? And so we were, I don't remember now, like 3 or 4 times oversubscribed for that. And I said, like, no, we're going to take a small amount because this is really just about proving whether there's worth doing anything more here. So let's kind of take the least amount that we think we need to be able to prove mostly to ourselves, this is something worth doing. And this is where we want to be spending our time.
Yeah. And so was it just kind of almost a friends and family round? So, or
yeah, we did institutions as well. But we did it, on a safe, and we kept it pretty small.
Okay. I guess let's go to the seed then, unless there's any other notable, interesting things about that pre-seed, but, yeah. When was it time for the seed? How'd you put that round together? Talk me through it.
Yeah. So seed was for us when we felt like the market was pulling. We said, yes, we validated this is what people want. We've sold some like meaningful 6-figure contracts. We've got really interesting bottoms up pull for our business. Like we have people using our product. We're getting feedback. We kind of feel like the market is pulling it out of us. And I believe very strongly in running incredibly lean, painfully lean, and perhaps going slower for a while until you feel like you've got product market fit and you feel like the market is pulling it out of you, or at least like the inklings of product market fit. And so we ran painfully lean for a while and really we're just kind of iterating and testing and learning. And to me, the seed was the moment where we said, okay, like there's something here. We need to now put our foot on the gas and really like resource up and go. Like we see the opportunity. We understand what this is. We think we know what it's going to take. Now it's time for us to really accelerate. And so we decided to raise the seed and, we're a process company. I care a lot about process, probably not surprisingly. And so we ran a very tight process where we went out and said, hey, we're going to raise, I can't even remember now. I think did we raise 6 or 8 million? I can't remember. It's been a while. We raised 6 or 8. We said, hey, we're going to go out and like raise this amount of money. This is how much we want to raise. We don't really want to raise more. We don't want to raise less. Like we feel like this is the right amount. And I said, I'm going to run a 2-week process. It's going to start on this Monday. It's going to, by the following Friday, I'm going to have signed a term sheet. And that's it. Here's what we're doing. Let's go. And we were pretty fortunate in that we had the full round, more than the full round committed on the Sunday before we even started our process from insiders and folks that we had known, for a while. So we were able to go into the process and run a pretty competitive one and really make it about finding the right capital partners for us and people we were really excited to be in business with for a long time. But man, it was a freaking exhausting 2 weeks. I crammed a lot into 10 working. I think we finished on Thursday, actually. So 9 working days. I lost my voice most days by the end of the day. I remember I was living in we'd gone down to, this was the middle of the pandemic. And so we'd gone down to LA for the month just to change up the scenery. And I remember like locking myself in the office of that LA rental and like not leaving for basically 9 days.
Yeah. Well, okay, let's unpack this a little deeper. So, first of all, 2-week process, that might be a new record on this show. We've had lots of people on this show. Usually when people say we run a really tight process, like 2-month process or something like that. So
and like I get that, but my pushback is I was like, my business cannot afford for me to spend 2 months, not paying attention to it. Yeah. And so I need to make this as tight and contained as possible. And I often believe that like time will expand to fill what you've given it. Work will fill to expand the time you've given it. And so we ran like a very aggressive timeline, but it worked for us. I'm glad we did it. I would do the same thing again.
So maybe talk about in that 2 weeks, what was the timeline like? Because you must have broken it down as a consultant, as a process person, even down into more granular steps. Do you remember what those steps were?
Yeah. So I'd spent a bunch of time doing pre-work before those 2 weeks, right? And saying like, who do I think would be good partners? I called a bunch of founder friends and asked them, who did they respect, who invested, who sat on their boards, who should we be talking to, who should we not be talking to? And so had, kind of a spreadsheet going of here are the people that I want to make sure I get some kind of exposure to, because I think they might be good for the business. And then who are the people who kind of I already know or who have expressed interest in staying in touch and whatnot. And so I teed up a number of conversations before the process even began. just to talk to people sort of like, hey, here's what we're planning to do, who would be kind of the right people to be involved and to make sure that we're speaking with that week. And so that was a nice kind of very low pressure, easy way to build a shorter list in that 2-week time period and get a sense for who we would want. Now, there are a bunch of people in that 2-week time period I never met before, right? And that was kind of our first time getting to know them. In fact, Amplify, who ended up leading our round, I met for the first time in that 2-week process. I had heard really great things about them, they'd backed friends of mine, sort of all the good things, but we never formally met. And so there was like a lot of really important pre-work. And then the 2-week process, like for me, I'm a very transparent person. And so it was just about being transparent. You sort of meet people and be like, we're writing the process. This is what it looks like. 2 weeks is really aggressive. I realize like that might not be enough time for you. And if not, I totally understand. Like we already have the money committed. So we don't need to be extending this any longer. And there were, maybe like a couple people were like, oh, that's too fast for us. We're not going to be able to meet it. And we were like, great, we'll talk to you at the next round. Right. Because a lot of these investors are multi-stage investors. But many people were like, no, I think I can make this work. Right. And this was, during a hot market as well. And so VCs had gotten used to, I think, moving a lot faster as well. When I was at Greylock, 2 weeks would have been really fast for a round. Yeah. We did it. We did do some that were that fast, but it was pretty uncommon. I think during the height of the market, it became much more common.
Was it like days 1 and 2, you're going to do first round pitch calls with everyone, days 3 and 4, second round? I mean, like, how did it?
Yeah, the sequencing becomes really important, right? Because we want to be kind of timing everyone. It's like when you're recruiting a bunch of candidates for a role, right? You want to kind of be batching them together so they're all sort of on a similar cadence. So yeah, you're trying to do all of your first conversations, ideally like Monday through Wednesday, the first week. Then you can start doing like second and third conversations through the end of the week, that weekend, because you want to be gearing up for partner meetings the following Monday. Now, what I found is a lot of firms became quite flexible and they didn't just do partner meetings on Mondays. They would do partner meetings. They either had a second day of the week reserved for us for that. At Greylock, we had ended up doing that. We had Mondays and Thursdays so we could move fast. Or a lot of them will just like spin up an extra partner meeting if they're excited, right? And just kind of like call their partners together. I think I even had one on a Sunday. Mm-hmm. So they'll kind of like work with you to make it work. And to me, that was actually a sign. We worked with we talked to a bunch of different firms. And one of the firms that we got kind of farther down the process with is, like arguably the best firm. You would definitely say, top 2, top 3. And, they were really great, but they had like a very clear process. They were like, here's our timeline. And like, we have these slots available and in sort of these partner meetings. And, and then I had others who were like, we respect what you're trying to do. We're going to work according to your timeline. Right. And you kind of tell us like, here's what we need on our end. And I felt like it was much more collaborative and partnership oriented. And I really liked that. And so I think for me, I also learned a lot about how different firms and partners approached the fundraising process and the way that they wanted to work with us. And to me, that was really great signal for like what working with them for the next, hopefully 10 plus years will be like. And I was looking for folks who like also would be kind of collaborative and work with us on the cadence that we wanted to.
Yeah, that's interesting. So first meetings, first couple days, second meetings, either Thursday or Monday, and then ultimately trying to get a term sheet. But how do you compress due diligence into that? Or do you just have like a data room that was totally loaded with everything or what?
Yeah, you front load sort of everything that they possibly need. And then, in that first conversation, because you say, hey, we've got a really tight timeline, like what is it that you need to see? Right. You tell me, I can provide you with all this data. Like we've got this ready to go. Here are sort of the customers I'm happy to make introductions to. But we saved especially our bigger customer introductions to the end, right? Because every VC will say yes. They'll say, sure, I'd love to talk to your customer. It's a way for them to buy time and buy optionality. Right. And so you almost have sort of like opposing incentives as a founder versus an investor going through this process. Because what the investor is trying to do is basically like earn the right to keep going through your process at every step, right? They kind of want, if they're interested enough in your company, they want to play it out through the whole thing. And what you're trying to do as a founder, if you have a lot of interest, right? If you're looking at an oversubscribed round, which we were, you're trying to narrow, all right? And you're trying to say like, hey, I want to limit this, right? I want to get down to, because I'm trying to narrow down to ultimately one. And so we would save, our our bigger customer references at the end and sort of say like, hey, we're happy to do something contingent on like great references and all those sorts of things. But like, we're not going to provide that to you until we are already at a point where like we're ready to shake on a deal. And then you can do your final diligence before we do.
Yeah.
Otherwise,
Really
those customers are going to get inundated by, how
any
many
other
people
little, because that's a great little tip. I mean, you could take an action item or tip away from what you just said there. Put your big customer references at the end of the process as a, contingency. Any other sort of little tactics that you could extract from that 2-week process?
Run a very clear spreadsheet, like do your pre-work in advance, come up with your short list, add more names than you think you should to that short list, come up with your short list and increase it by 30 to 50%. I maybe hesitate saying that because I've had some founders who will show me like a spreadsheet with 200 names. I'm like, that's too many. But most people have like 5 to 10. And I'm like, add more because you don't know, right? It's very much like a dating process. Like there are a lot of things that have to match up between you and an investor. It's not just about you being a great company or them being a great investor, right? There's a lot of things that have to connect. And so you want to be casting a wide enough net. And so like do your homework in advance, right? Figure out who the people are, talk to a bunch of founders, figure out who those people are. What do they invest in? Why would your company be interesting? Why are they interesting to you? All of that. And then you structure a really clear process where you say, and you need to plan this in advance because VCs like calendars really book up, right? And again, if you're like a really hot company and well-known, they'll make time for you, but otherwise you're going to get booked like 2-3 weeks in advance, right? And so you can't just ping them on the Monday you've started your process and say, hey, do you want to meet? And ideally you've gotten warm introductions, right? So it's not even you pinging people, it's other people have made all those intros for you. But then you want to be thoughtful about lining up those meetings so that they're all coinciding. So you're having your first meetings kind of all around the same week, right? And then they're all going to be on a similar cadence afterwards.
Yeah, that's good. You mentioned a couple times that basically the round was committed kind of before running this process. So what does that mean and how did you do that?
Yeah, it came from folks that I'd gotten to know and insiders. So it's kind of like a mix of both. And I don't know, it wasn't something I solicited. It was, I just went around telling people like, we're starting a round. It starts on Monday, right? Here's what it's look like. I've got 3 criteria that I'm looking for in a partner, right? Here's what I want. Who should I be talking to? And, people would make a bunch of introductions and recommendations there. And then, through that process, like, again, folks who had kind of been close to the company already came together and like a few of them, and they were like, I'm interested in putting in, X million, like, here are the terms that I would want. So that was not something that I designed, but it meant that we were really fortunate going into a fundraising process where it wasn't about, can we raise money? It's, who are the best partners for us and what does that look like?
So everything you said is like this dream scenario for most founders. And, I think you're able to run such a tight process and have this interest because you were a, quote unquote, hot company. So what was it about the company that made you a hot company? Was it some growth metrics? Was it your team's background, some combo? What?
Yeah. I mean, I don't think there's anything different than what like most investors look for in companies, right? Which is like a combination of the founding team, and the space that you're going after, and the, the growth potential and like early signs, of that along the way, whether that's like customer attraction, whether that's revenue, like whatever the metrics are that you're looking at. Seed rounds, I mean, you're raising mostly on promise, right? So you're starting to see the ramp of the company. And then the question is like, do you squint at it and say like, I can see how this like ramps even more. And these are the right set of people to go after it. And this ramp, there's no limit at the top of it, right? I see that this can be a multi-billion-dollar company because this is a really exciting category or this is a new category. And so every investor is doing those calculus of those 3 things, and different people put different weights on those. But it's like every hot company is different, but they're usually like all the same for like one of those reasons.
Yeah, no, that's good. So again, this perfect scenario, being a hot company, you have quite a few, actually 2-part question. How many companies how many funds were you talking to in that whole thing? And then how do you say no to firms that maybe you really like, but you can't let all of them in? So, yeah.
Yeah. We talked to, in that 2-week period, I'm trying to remember, don't quote me on this, but maybe like 20. or something, like maybe 15, maybe 20, 15 first conversations. Yeah, that sounds probably right. And saying no is hard, but it's also not, right? Because the thing about investors, there's a big asymmetry between a founder raising and an investor investing. Investors do this every day. This is literally their jobs. Founders do this, once a year, once every 18 months, every 2 years, right? And you are doing a million other things. You have to be good at fundraising, but you also have to be good at many other things, right? And so investors get it, is my point, right? They get that you are running a competitive process, right? They get that you are talking to other investors. They get that you're trying to get the best deal, and deal can mean many different things, not just price, right? You're trying to get the best deal for you and your company. And so they're like very sort of understanding, I find, if you're being quite transparent about it, right? And you sort of say, for us, the 2-week timeline was really helpful in winnowing it down, because some people be like, I just don't think I can get there in that short of a time. And you're like, great, totally understand. Let's stay in touch. We'll be raising future rounds. And most investors are like quite happy to do that, right? And they're like, okay, great. I'd love to see you at the next round. Maybe I can get you then. The harder one is like when you get really to the end of the funnel and you've hopefully built really good relationships with people, and you can't work with everyone that you want to. To me, the most stressful part of the fundraise was putting together the sort of final round, not determining the leads, but like who are all the angels or sort of smaller funds and everyone. And we were quite oversubscribed. And so you just don't have enough space to be able to let everyone in. And that means everyone's going to be disappointed, basically, because you pair everyone back, right? No one gets the allocation that they want. And some people don't get any allocation at all. And that to me was like the quite stressful part of it. But, I even talked to our investors through that, and they were like, look, I get that you're stressed out by it, but you got to remember, all these people on their side are professionals. They do this for a living. And so they understand, and, it feels like a big deal to you, but it's not. At the end of the day, like, your relationship will still be there, and you'll still be fine. So I think it's one of those things that feels really hard in the moment, but as soon as you get a little bit of distance from it, you realize it's not that big of a deal. Like, you just need to do what's right for your company, and
That's
everyone
good
will
advice.
respect that.
Yeah, I like that a lot. All right, one or two more questions. I'll let you go because you've got a business to run. What were you optimizing for in putting that, that round together? I mean, there's lots of different ways: optimal terms, optimal price, investors who have the value add, and maybe round out skills you don't have. I mean, there's all kinds of ways I've heard people kind of create that optimal investor pool. But what did you do?
Yeah. I thought a lot about the person in particular, because especially for a seed stage investor, and that this person ended up joining our board for our lead, it's kind of like a marriage. Like, you spend a lot of time choosing the person you're married to. You spend a lot of time choosing your co-founder. You spend a lot of time choosing your early founding team, like the people you surround yourself with, the people you're building your business with, and your investor should be no exception. Right. And so I was looking for someone that I wanted to be in business with for a long period of time, and who, I felt like I could build a great business with, and who would give us good advice and good counsel, and sort of had the best interest of the company along the way. And then I was looking for, I'm trying to remember, because I had 3 very clear criteria at the time. And I think one was do no harm, which you might smile and laugh at as being a low bar. I have seen a lot of investors do a lot of freaking harm to companies, a lot of times unintentionally, sometimes intentionally too. And so I was like kind of cheeky, but serious. I was like, step 1, do no harm, right? At a minimum, I'm looking for people who won't hurt our business. And by the way, that could look like multi-stage investors who don't invest in your future rounds. And so I was really thoughtful about the types of firms that I talked to for a seed stage round in particular, because of that, right? Because of the signaling risk from that. And then 2 was like, I want people I just want to be in business with for a while, where I feel like I can build a great relationship with them. And we're very fortunate I have that with my investors. I'd say, like, there are many joys to me in building Scribe. One of them is building them with our investors. They're just people I really like, and really respect and enjoy spending time with. And then the third was like folks who could round us out, and who had sort of expertise or networks, at least in the areas that we thought were going to be really important to the business. And for us, that was particularly on the go-to-market side.
Yeah, good. Okay. Last question. This is my favorite question. What advice would you give your younger self if you were doing this all over again? Or what other general fundraising growth advice do you like to share, that we haven't covered?
I'm quite happy with the outcomes that we've gotten. So I don't know that I would give myself different advice about how to run the process. I would probably give myself different advice about how to feel while running the process. Right. I was quite stressed. Even even like being in, we were a very kind of fortunate position going in. It was like relatively low stakes. It's just really stressful, to be like trying to run a business while you're fundraising, right? So you're fundraising, kind of between the hours of like 8 and 6, sometimes 7 is when you're doing your fundraising conversation. And then you're trying to run your business like at the hours between 7 p.m. on and plan for the next day of fundraising. And so it was a lot. And I think the advice I would give to myself is, maybe take it a little less seriously, right? Like it matters, it's important, but if it's meant to get done, it'll get done. And maybe enjoy the process a little bit more along the way.
Good stuff. Excellent.
All right. Not that anyone really goes into a fundraising process and says, man, that was so much fun. But I do think it's an opportunity, actually, if you shift your mindset from a performance one of like, how do I get this person to think that my business is great, to a curious one, like, hey, this person's seen a lot of businesses and I've got a lot of open questions to answer. Every business has a lot of open questions to answer. I don't care what stage you're at. Like, I wonder if this person has some perspectives on my business that can help me think about how I answer these differently, right? Or shed some things in a different light. That is a much more enjoyable conversation. Right. And by the way, like VCs like that better. Like if you're sitting through 5 pitches a day, like if it's just everyone like trying to impress you every time, that's really boring. But if you get a founder who comes in and is like, oh, I'm really grappling with this problem, right? Like, how have you seen other companies solve that? That's more helpful for the founder. First of all, it's probably more interesting for you as an investor.
Yeah, I like that a lot. I tell founders kind of treat it like a game, make it more, to make it more fun, less stressful. And I tell them like, you're going to learn a ton about your business from going through this process. Hopefully you end up with a check at the end, but either way, just going through meeting with these investors, you're going to learn a ton. And so, yeah, I like that kind of.
You learn a ton, but you also have to separate signal from noise. You know, like I had one investor, he's like quite well respected, and he like could not get hung up on how we don't deal with physical documents. He's like, well, what about faxes? And I always was, I'm like, my business does not deal with that. And he was like, that feels like a really important missing component. And so there's like a number of these things where you're going to find many different perspectives on your business. And that's great. You should listen to all of them and see what you can learn from it. But you also should ignore quite a bit of it too, because a lot of them are just opinions. And at the end of the day, like, your business best. Yeah,
very true. Excellent. If people want to learn more, it is simply scribe.com, correct? Or is it?
Scribehow.com.
Scribehow.com. Excellent. And is this
got a free product, so folks can go to town. It takes literally 4 minutes from the moment you land on our site to the moment you're able to create and share a scribe. So next time you have to share how to do something with someone, you're scaling up your team, or your customer wants to know how to use your software or whatever, like give it a try. Free product is great.
I love it. Scribehow.com. Jennifer, thank you so much. This is super interesting, fun, and congratulations. And one thing we didn't cover, and we can, if you have a minute. You were doing this all while pregnant, right?
We raised our Series A while I was 8 months pregnant.
Okay, that's amazing.
Yeah. That was a preemptive round, so we were not planning to raise, but we had an opportunistic conversation, and then when we were going on the path of doing it, it was 6 months after we'd raised our seed round. We hadn't spent any of the money from our seed round, and so my first thought was, well, gosh, is this like the right time for our business? Even we don't even need this money. And then my second thought was like, is this a good time for me to be raising? I'm like about to have my first baby, and I've never seen a pregnant founder before. And I've been around VCs who literally can't say the word pregnancy because it makes them uncomfortable. So, am I even backable? Is this even a good time to be doing this? And it all turned out, great and fine in the end. But that was a trip.
That's funny. That's good. All right. Excellent. Well, thank you so much. We'll catch you after your next round. Maybe you'll be on baby number 2 at that time, and we'll have some more fun stories to share. Who knows? Cool. Excellent. Scribehow.com. Thank you, Jennifer. Over and out.
Thanks so much.